Hey guys, JC Parets here, founder of Stockcharts.com, and welcome to our monthly little powwow where we go over, what I think are the most important charts in the world for stock market traders and investors. And I think it's really important to zoom out first, right before we're like, oh my God, when are these small caps going to stop going down? Or when are these Cathie Wood stocks going to stop going down? And the Biotechs. The S&P 500 closed at a new all-time high 2 weeks ago. Highest levels ever. And then over the last 2 weeks, we have not closed at new all-time highs. All right, that happens. If the world was really about to fall apart and the selling wasn't just reserved to some of these growthy areas like biotechnologies and those ARK funds and all of those areas, and if things were going to really spill over into global markets and there was real systemic risk, we'd be seeing that in credit, and we're just not seeing that. Credit spreads are as narrow as they've been in quite some time. So we're not seeing any stress in credit. Now, with that being said, so here we're looking at junk bonds versus treasuries making new highs. We're looking at junk bonds versus investment grade bonds also making new highs. We'd be seeing them roll over. Now, to be clear, so if these were rolling over, that means credit spreads are widening. As these are going higher, that means credit spreads are contracting. It can be coincident. In the fourth quarter of 2018, credit spreads widened, particularly in America, that coincided with equities selling off. In most occasions, you see it ahead of time. Like in 2015, credit spreads were widening well below that spring peak in the S&P 500. In 2007, you most certainly saw it for 5 or 6 months beforehand. And before the COVID crash, you were already seeing credit spreads widening for months before COVID crash. So yes, it can be coincident. Usually it's leading. Right now, we're not seeing any stress whatsoever. So I find that really, really interesting and something that we want to pay attention to, because if you want real information, it's in the bond market. I think personally the bearish argument for stocks right now has to be a massive failed breakout in the U.S. 10-year yield. We're getting new highs as we speak, highest levels that we've seen since pre-COVID. And I think that if the selling, we've had a major move in rates, right? I think we've had the worst start in the bond market that we've seen in quite some time. And all of this has to do with stocks, because as fast as interest rates have moved higher in that environment, that's going to trickle into those long duration growth stocks that have gotten hammered. So if that's what happened, interest rates spiked, and you're getting that sympathy selling in those other areas that are exacerbated because in a lot of cases that started in February. If rates roll over here, regional banks are getting hit, oil, we lose oil, the energy names start rolling over. I think in that case, credit spreads start widening, and that's a problem. I think if rates hold these levels, I think you're ultimately, and just settle down, right? Because rates are spiking. The market doesn't like it when rates move really, really fast in either direction. So a slow, steady move, I think, can coincide with a rising stock market. But that 1.4%, that's big. And interest rates are rising. So we are in an environment, and when we're looking at which stocks we want to buy and what stocks we want to trade and which stocks we want to avoid, we need to ask ourselves, what's the bond market doing? Is this a rising rate environment? Is this an environment where rates are falling? What types of stocks tend to do well in a rising rate environment? As it turns out, it's not the stocks that did well in 2020 when rates were falling. It's names like energy. Here we're looking at the equities for rising rates fund, EQRR, making new highs. And then, when you look at the components, you've got a ton of financials and energy. So when you take the financials and energy sectors and equally weight them, it looks exactly like that equities for rising rates ETF. Energy, look at those two sticks back-to-back weeks, new highs. Crude oil futures making new 7-year highs. So this is the type of environment that these stocks do well in a rising rate environment. You know what else tends to do well in a rising rate environment? Historically, if you recall, back in 2003, 2007, there was international outperformance. Developed markets outside of North America were outperforming for years. This was early in my career. I remember like it was yesterday. Emerging markets were also outperforming. What else was happening in that environment? Large cap growth was underperforming value. The value areas were where you wanted to be, both in the small caps and the large caps. Technology and growth names were an afterthought. They went up over those years. They just went up a lot less than the other names. I remember in those times we were buying energy stocks, Lehman Brothers, Bear Stearns. Kids, look it up. They used to be big companies. Merrill Lynch, MER. Those were the names. Peabody Energy and Halliburton and Schlumberger, and like those were the types of stocks that we would buy back in the day. Technology stocks were an afterthought. That's not where we wanted to be in that environment, and that's what we're seeing today, right? So this environment was 2003 to 2006 when emerging markets and the rest of the world was outperforming the United States. What are we seeing now? We're seeing similar. Last year small cap just got crushed. All year long, just really, really got hurt in terms of the growth, and then large cap growth held in relatively well. It was really small cap growth that got crushed. Small cap value was the big leader there, and you could really see it in the 2021 returns where people were like, well, the market was, held up by 5 names, blah, blah, blah. We know for a fact that's not true. Small caps held in just fine, particularly small cap value returned the same as the S&P 500. It was small cap growth that was the big underperformer last year. So I think that's important to recognize. Looking underneath the surface at what's been happening, you notice almost 40% of the New York Stock Exchange is down over 20% or more, and 12% of the New York Stock Exchange has been cut in half. Just to show you the dramatic difference, 70% of the NASDAQ is down 20%. 70% of stocks on the NASDAQ have lost 20% of their value, and actually 42%, almost over 40% of the NASDAQ has been cut in half. So you have over 3 times the amount of stocks on the NASDAQ that have been cut in half than you do on the New York Stock Exchange Composite. And why is that the case? Well, in the New York Stock Exchange, you've got a lot more exposure to the value areas of the market, more industrials, financials, energy, materials. In the NASDAQ, you don't have any financials. You don't have any energy. You don't have any materials. You barely have any industrials. Also, much more international exposure on the New York Stock Exchange, which obviously tends to have more exposure in those cyclical areas as well. So just much different markets. And by the way, just as an update, the average stock on the NASDAQ is actually down 42% off its highs. So these things have just gotten slaughtered at one point or another. They really need to dig in. They really, really do. And as you can tell, the average stock on the NASDAQ, on the New York Stock Exchange Composite, is down nowhere near that. All right, let's get into some of the individual sectors. Financials closed at a new all-time high 2 weeks ago. They did not close at a new all-time high last week. We've seen some selling pressure from JP Morgan and Goldman Sachs recently, for example. This is one of those rare instances where the further down the cap scale you go in this particular sector of financials, the better they've been performing. It's the mega cap financials that have been struggling, they did well for a while, that have given back some of their gains. The regional banks, community banks, it's really where we've seen the strength. Take a look at Silicon Valley Bank, SIVB. SIVB hanging in right there. It's right there. So 667, we're just below that. If we're below 667, it's not really for me. I'd rather be above that, but definitely one to keep an eye on for sure. And you really want to see the banks hold these breakout levels. You've got KBE, which is the bank ETF, the regional bank ETF, KRE, and of course the community banks, QABA. These are failed breakouts. That could be nasty for financials, so definitely keep a close eye on there. And then we brought out the old minor leaguers report this week. So these are stocks between 1 and 4 billion. I understand that traditionally small caps are capped at $2 billion in market capitalization. We make our own rules around here, so we increase that to 4 billion because it's been 2 billion like forever. But now you have $1 trillion companies, so you got to bump up the little guys. For us, mid caps go like to 30 billion when traditionally they just go to 10. So we're just changing the rules here. These are the minor leaguers. A lot of financials showing up, a lot of relative strength in those areas. So we want to keep an eye on it. One of the things that I like most about the financials trade is that you're going to know if you're wrong early, right? Like, for me, it's less about how much money I can make and how high it can go and all these things and the Ferrari and the new house and the jewelry. It's not for me. I want to know that if I'm going to be wrong, I'm going to know quickly that I'm going to be wrong so I can move on to something else and not be sitting there wasting my time with something that's not going in there. So I really like the fact that in this particular case, a lot of financials today are set up where if you're long, you'll know you're wrong very quickly. And in some cases, haven't even broken out yet, and we're looking to buy a breakout. So I really, really like that. One name that stands out, this might be my favorite name. I don't want to say my favorite. You're not supposed to have like a favorite child. But Cathay General Bancorp, the old joke on the trading desk yesterday was that you want to be long Cathay, short Cathy. Ha. You know, when jokes like that start being introduced to conversations, might be a little long in the tooth, you know, on that trade, shorting Cathie Wood stocks at this point. You know, that's not really for me. While we're on the subject, as a matter of fact, here's what we can do. So what I'm going to do is I'm just going to bring in, look at this, live, bringing in stuff that I hadn't even planned on bringing in, and so that we can talk about it because we're on the subject. And that is, do we have it? Slide 44. Nope, we don't have it. Oh, wrong deck. All right, just so I'm not going to be able to show it because I don't have it in this particular deck. But we're looking at about 81.5 on the ARKK, 81.5. If we're below that, I think you leave it alone. But above 81.5, if you're in it for a squeeze, I like that. So rather than shorting Cathie Wood, like the joke suggests, I like buying on the upside if it's above 81.5 on ARKK. So just full circle on that comedy hour from some of the traders that we talked to. But CATY, I really like this name a lot. If it's above 46, below 46, I think you leave it alone. It's a little messy under 46. If we're above 46, I think you own it. Target up near 63. It's a $3.6 billion regional bank stock, breaking out on a relative basis. Look at OFG. It's a $1.5 billion regional bank. OFG. You know, nice reversal today off the lows. They knocked it down in the mornings, coming all the way back. If we're above 30, I like this one long. Below 30, leave it alone. Above 30, I like it long. Target up near 48. And then Horizons Bancorp, HBNC. HBNC, I like this if we're above 22. Currently, we are. If we're above 22, I like it long. Below 22, you probably want to leave it alone. It's a $1 billion stock. And then Progressive, PGR. So this one comes not from our small caps, obviously, but this one comes from our Hall of Famers report. And these are the biggest companies in America. If Progressive is above 62, if Progressive is above 100, we want to be long with a target of 157. It's a $62 billion market cap. And what I find interesting is that you're getting financials that are popping up on our minor leaguers report, which are small caps. You're getting financials popping up on the Hall of Famers report, which are the largest companies. And then you're also getting financials popping up on the Young Aristocrats report. And these are stocks that are raising their dividends every year for between 5 and 9 consecutive years. So some of you guys who have been around for a while might be familiar with the Dividend Aristocrats. These are stocks that have raised their dividends every year for 25 consecutive years. By the time you get to 25 straight years, you probably missed a big chunk of the move in our experience. They can keep going, obviously, but you probably missed. So what we try to do is we try to catch them early. So we're looking for stocks that have raised their dividends every year for between 5 and 9 consecutive years. And this is what this report is. And you can see a ton of financials, just like some of the other scans. Check out Wintrust. This one coming from our Young Aristocrats report. This one pays a 1.23% yield. It's raised their dividend 8 straight years. Another regional bank stock, about $6 billion. WTFC. And we're looking at $100. It's right there as we speak, literally right there. So if we're below, this is a good example of what I was just talking about. It's not about being right or wrong. We're not here to be right. We're here to make money. And in my opinion, and in opinion of a lot of smart people I talk to, a great way to make money is to not be hanging around in things that are losing you money and not be hanging around things that aren't making you money. I want to know that I'm wrong fast. I want to know that I'm wrong right away, this week, next week. I want to know soon if I'm going to be wrong instead of, 6 months from now, hey, that trade we made 6 months ago, I guess we were wrong. Like, that's no good. I want to know soon. So if we're above 100, we want to be long. Below that, I think you leave it alone because that puts us back below those 2018 highs. I think you got 50% of upside. First, Commonwealth, FCF. So, again, all these financials keep popping up on a lot of our scans. And again, I think we're going to know we're wrong quickly. 18 here. If we're below 18, leave it alone. So we haven't broken out yet. This is one of those cases where we sit and wait. And if we break out above 18, we buy the breakout. And then MetLife really showing a ton of relative strength while some of its peers have been getting hit over the last few days. MetLife hanging in just fine. If MetLife's above 63, I like this one long with a target just under 100. And then here's that Hall of Famers scan that we're just talking about. So these are the biggest companies in America, names that stand out. Also, industrials, something that's worth pointing out. Industrials have the highest correlation with the S&P 500 of all of the S&P sectors, really hanging in there just fine. While a lot of these growth areas have been getting crushed, also industrials are a very diversified sector. You've got, delivery companies, shipping companies, you've got railroads and truckers and airlines, and then you've got like staffing companies and like engineering companies, names like Caterpillar and GE. So you've got like all kinds of way different kinds of companies. And that's probably why it's the most positively correlated with the S&P 500, even more so than tech, which is the biggest component, more so than financials, right? So industrials really, really, really moving with the markets. And I think this really tells an interesting story because, I would say the average stock in the market probably hasn't done much in quite some time, and industrials haven't either. But this, to me, looks like a constructive consolidation within an ongoing uptrend. There's no evidence that it's not that. So I think it's constructive. We want to look at some of the leaders in that group. Illinois Tollworks, ITW. This one popping up on our Hall of Famers report, which, again, are the largest companies in America. Ton of strength in this name, pushing up against new all-time highs. There's nothing not to like. If we're above 237, I like this one long, and currently we are above 237, so I definitely like this one long. Another one is PSA, Public Storage. This is a REIT. Coming up on our Hall of Famers report, REITs were the second best performer last year after energy in terms of U.S. sectors. 353 is the level there. If we're above that, I like a long target, 474. And then Coca-Cola. We've gotten some strength out of staples recently. Coca-Cola hanging in there just fine. This is another one of those examples, furthest thing from a bank, but it's the same idea. If we're below 60, you can't own Coke. It's that simple. Below 60, you don't own Coke. Above 60, I think you can own it with a target up near 75. If staples continue, I think you're going to get that breakout. But again, it's a great situation because if you're below 60, it's somebody else's problem. It's not our problem. So consumer staples showing strength, right? And people are like, well, JC, if money's going into consumer staples, that's a defensive area. That's not good for stocks. As it turns out, when you look back in history, when the S&P 500 is making new all-time highs, staples tend to be making new highs also, right? It's perfectly normal. If the S&P 500 is selling off hard, consumer staples are probably selling off hard too. It's when consumer staples are outperforming for a sustained period of time, and that's really where the problem lies. So if we're above 75.5, I like staples long. I don't think there's any reason not to own staples. They've certainly shown relative strength recently. And if we're below 75, you leave it alone, right? And Coca-Cola within that. So if staples are going to go, Coca-Cola probably should do well, showing relative strength. Where I would, as a market participant, as a stock trader, for everybody out there listening, it would be staples continuing to outperform. That would be a problem. They've been outperforming for 2 months now. They bottomed on a relative basis at the end of November. So almost 2 months. The outperformance, I would argue, probably started early December. So we're probably going on about a month and a half of outperformance, making new relative highs now, new recovery relative highs. If we start holding above 17, which currently we're not, but if we do, and we're back below those former lows on staples on a relative basis, that's probably not happening in an environment that stocks are doing well. I would argue probably stocks are probably still under pressure. And then the low volatility ratio also, if low volatility stocks are outperforming staples, if low volatility stocks are outperforming the rest of the market, that would also be most likely be taking place in an environment that stocks are under pressure. And then finally, I want to talk about a little bit about what's going on around the world and how we can take advantage of that, because we're certainly seeing some shifts. I don't know if you've noticed, Brazil has been going up for over 2 months now, making new multi-month highs as we speak on the EWZ in Brazil. And China holding in there fine also, basically going up almost every single day, but a couple since the year started. I want to look at the all-country world, because remember, when we looked at that rising rate environment from 2003 to 2007, emerging markets were outperforming that environment. Stocks in countries around the world were outperforming the United States in that environment. So that's what we're looking at here. At the top, it's the all-country world index ex-US. If we're above those 2018 highs, the world's probably fine. World's probably outperforming the U.S. But at the very least, we're still in a healthy stock market environment. Or perhaps, depending on how you look at it, we are entering a healthy stock market environment, depending on what types of stocks you've been in over the last year. Developed markets outside of North America, EFA, right? So you're getting a lot of Japan and Europe in there, obviously. And what are you seeing, right? Those 2018 highs. So as long as we're above those 2018 highs in these two indexes, I think there's good information here. We broke down, if you zoom in, we're looking at every single sector, every single country in the world, and breaking it down by their percentage exposure to value sectors versus the growth areas. Hong Kong, actually, the most value exposure. I thought it was interesting. I figured Taiwan had the highest growth exposure, and they do. I didn't realize the United States is number 2, behind only Taiwan in terms of growth. So I did think that was certainly interesting. And then here's emerging markets as a group. So here we're looking at emerging markets on an absolute basis. And where did EM stop going up? EM stopped going up at the same place it stopped going up in 2007, 2008, and has really been consolidating ever since. So this looks to me like, what could be referred to as the Schnauzer formation, right? Because it kind of looks like a Schnauzer off of the lows, right? Kind of looks like a Schnauzer's face. And that tends to be bullish, which I thought, I always find that, when they call things after animals, I find that to be hilarious. To me, this looks like a healthy consolidation. It looks like a healthy digestion when you zoom out. I understand that short term, obviously, we've seen a lot of pain in emerging markets, but when you zoom out, it seems justified, does it not? Seems justified to me. And we've certainly seen relative strength recently. And then what about that relative strength out of Caterpillar, right? I mean, when you zoom out, Caterpillar looks exactly like the EEM. It looks exactly like it. So if this strength in Caterpillar is any indication of what's to come in emerging markets and what's to come in China, I think it's probably positive. By the way, the advanced decline line in emerging markets looks way better than the advanced decline line in developed markets. And if the dollar does roll over here, that means that this black line is probably going to roll over also, which means that emerging markets are outperforming. So I really do think that this becomes a U.S. dollar situation. So let's talk about that U.S. dollar real quick, because I really think it's important. Here we're looking at the U.S. dollar. This is, to me, how if the emerging market trade is going to work, base metals are going to break out, stock market's going to go up from here. The worst companies in the world that have gotten crushed are going to bottom out. I think this needs to be a top in the U.S. dollar. I think it needs to be a top in the U.S. dollar. EM over DM is going to be the password for the slides, by the way. So, guys, I know some of you guys are interested in the slides. You can go to email info@allstarcharts.com. We'll send over the slides, info@allstarcharts.com. And obviously, maybe not obviously, make sure to use the password, because I do give a lot of presentations. You want to make sure you get this deck. EM over DM is the password. EM over DM. EM over DM is the password there. Info@allstarcharts.com. And we'll go ahead and send you the slides. So when we look at the U.S. dollar, let me just go right back to the U.S. dollar so we can get an idea of what's going on there. If this is a top, right, and this is just a retest of the breakdown last week, and then we break down. If it's like this, and that breakdown last week is a failed breakdown, and the dollar rips from here, I got to tell you, that's probably not happening in an environment that emerging markets are doing well. Brazil and China are probably rolling over. If the dollar's ripping, I think this is what you need. I think you're going to need to see that weaker dollar. If we get that weaker dollar, I think that's your emerging markets trade. I mean, just take a look at Freeport-McMoRan. Continues to show strength. This has been a monster winner for us, for you guys following along. Just absolute monster winner. New highs today, as a matter of fact. And then notice how it looks exactly like emerging markets, right? And then, not to be Pollyanna, here's the bear case. The bear case is this is a double top in Freeport and emerging markets, so the heads up that something's wrong. I don't think it's like this. I think it's like this, personally. This is how I think it is. And then this is the Latin America and Brazil. You know, seeing strength, seeing signs of strength that, you know, I wouldn't expect to see. If you're telling me that Biotechs are making new lows, IPO index is making new lows, all the Cathie Wood stocks are making new lows, you know, I think about what else is the worst thing in the world other than those. I think China, I think Latin America, Brazil. Chile's been ripping. Peru's been ripping. Brazil's been ripping. Take a look at Vale, V-A-L-E. I think there's really interesting strength there that you wouldn't expect. And, you know, Canada's been doing great. You know, what are the best performing areas in the world? Financials and natural resources and energy. That screams Canada. But you know what else it screams? It also screams Brazil, right? Brazil's got a ton of exposure in those areas, and you just haven't seen the strength like you have in Canada. I mean, far from it. These are 3-year returns, but when you look even shorter term, you just see tremendous bifurcation when theoretically, based on its components, this should be an environment where Brazil's doing well, and it has not been doing well. So that's definitely something that we're paying attention to. If you get that dollar weakness, I think Brazil's going to do well in that environment. And finally, we got a couple of minutes before we run. The Commitment of Traders report is interesting. Commercial hedgers, super bearish of the US dollar index futures, extreme net short positions in the dollar, extreme net long positions in Aussie, right? So a ton, really interesting there. So if the commercial hedgers are right, and they're certainly positioned for a weaker dollar, if they're right, I think that's good for risk assets in general. Energy stocks are probably doing well in that environment. Crude oil is probably doing well in that environment. LNG continues to be the strongest energy stock in the world. I personally look at all of the energy stocks in the world, and none of them look like this, right? None of them look like this at all. So our levels remain in place. Target of 124 still in place. Oxy, another one potentially breaking out here. We like Oxy long if it's above 32. Ton of relative strength. You know, it doesn't look like LNG relative strength. This one looks like most of the other energy stocks that are showing relative strength. LNG is like on a planet of its own. Oxy looking strong for sure. Only long if we're above 32. Below 32, we want to leave it alone. And we're seeing it when you go down the cap scale, right? Look at the S&P mid-cap energy index making new highs. And I'll leave you with this last one. This is Magnolia, MGY. $3.8 billion oil and gas explorer and producing company, MGY. And if we're above 22.5, which currently we're not, by the way, so we're waiting for a breakout. If we break out above 22.5, we want to be long. Target of 34.40. And I got one more chart. Give the people what they want, JC. Got to give the people what they want. And that's the Bitcoin, right? Everybody wants to talk about cryptos. I got to tell you, they better hold 41, because if they don't hold 41, 30's coming next, and probably even 20, right? Because if that 41 breaks, that was resistance at the end of 2020. It was resistance again last summer, turned into support in the fall, support again fourth quarter, support again. If 41 breaks, you're looking at 30. And if you're looking at 30, that's probably going to complete a massive double top, and you're probably looking at 20. So another 50% decline potentially if we break 41. So for you Bitcoin people, you know, just make sure you're managing risk, be responsible. There's no reason to be in some of these, you know, there's stronger areas, I think, in cryptocurrencies. Let me just point you to Fantom. If we break out above 320, we want to be long Fantom. If the secret network is able to break out above those 2018 highs, we want to be long. Near Protocol just added to Binance for you guys in America, 17.5. On the Near Protocol. If we're below 17.5, you want to leave it alone. Currently, we are. If we're above 17.5, I think we want to be long. So that's what that looks like to me. Some of you guys are premium members of All Star Charts. Make sure you go check out the quarterly playbook. 144 pages. We talk about everything that you need to know. So just a reminder there. And then again, if you have any questions, you know where to find me. info@allstarcharts.com. If you're interested in the slides, shoot us a note. Make sure to use the password, though. EM over DM. EM over DM is the password. Info@allstarcharts.com. I am JC Parets. I hope you enjoyed this. Talk to you soon.
Hey, Grayson Rose here with Stockcharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're going to bring you daily content from an incredible collection of technical analysts and financial experts.